The Treasury bills market witnessed some level of demand for long-dated bills despite weak supplies. However, the market is still traded on a quiet note. Traders at Axis Bank said they expect the sentiments to persist ahead of today's Treasury bills auction. Dimeji Obasa, fixed income dealer at Axis Bank, joins me for market updates. Dimeji, thank you for taking the time out to join us. Oh, there you are.
Thank you for having me.
Thank you for joining us. Let's get right to it. There's an Treasury bills auction today. Let's start with that. What are your market expectations in terms of subscription levels and, of course, the yield?
So there's a Treasury bills auction today where a total of 217 billion will be on offer across the three standard maturities. With regards to the expectation, we do expect a significant drop in the closing rates across board, particularly on the longest dated bill, which will be the 364 day Treasury bill. We forecast at least a 250 basis point reduction from the last stop rate of 4.78% at today's auction.
That's a bit of a haircut. Why do you predict that high?
So what we've seen over the last 2 weeks has been significant demand, particularly for shorter dated instruments, so short tenured bonds as well as Treasury bills. We've seen this 1 year Treasury bills trade in the secondary market as low as 1.1% levels. So we expect that demand will then filter on into this auction that is scheduled to hold today, given also the level of system liquidity. We expect all that to put together would reduce the closing rate at the auction significantly from the last stop rate.
Right. Bring us up to speed on action at the bond market and, of course, the money market.
So similar to the Treasury bills markets, we've also seen significant demand on the bonds market, particularly on the shorter end of the curve, from the 2028 down to the lowest trading security, which is the 2024. We've seen a lot of demand. The 2024s in particular traded around 6.6% yesterday, while the 25s traded at 9.4%. All this demand is as a result of the higher level of liquidity in the money market, which market participants are looking to deploy to these instruments. Preferably, the shorter tenor securities is where we've seen a lot more activity, while on the longer end of the curve, the market still remains bearish, given the expectation for higher yields.
I was going to ask you, what is the investment play here? I'm just trying to get into the minds of the typical investor this market. What is the investment playbook here? I know that, we do watch events, especially with the Fed, what's happening with the Fed. We're seeing a stronger jobs market. Fed may not go as strong on the rate hikes as everyone did expect. So, but how is all of this playing into the decisions of investors here?
With regards to the Treasury bills and FGN bonds market, the Fed rates would not necessarily affect it, given that these are local instruments. They are more affected by the level of system liquidity. However, on the Eurobond side of the market, what we've seen is some sell-off across SSA sovereigns, as a result of the recent wave of downgrades. Just yesterday evening, Egypt was also downgraded. When you put all of this in addition to the fact that the Fed is expected to continue to increase rates, albeit not as much as the market has expected as far as the last two increases have been, but we still expect that inflation will continue to be tamed by the Fed. That would then affect all dollar-denominated instruments, so we would expect that yield to continue to increase on the Eurobond space.
All right, let's quickly talk about the FX market. How are things shaping up there?
So what we have in the FX market is still relatively the same dynamics as far as supply and demand goes. We have the supply in the market not enough to meet the demand. So what we've seen is the NAFEX and INE trading at 461 levels rather. We can still say that demand significantly outweighs supply, as scarcity of the FX still persists in the markets.
All right. What is your forecast for trading for the rest of the week, and what can we expect from the yield curve?
So what we would say for the rest of the week is, following the close of the NTB auction today, we should see a post-auction rally, as a lot of the unmet demand from today's auction will filter into the secondary market. That would then filter into the bonds market, as investors may not want to take up the bills at the low levels that they'll be trading. So we would then expect that the demand would filter into the shorter dated bonds. We expect that the 24th through to the 28th would see significant demand as investors try to deploy their cash. It's also worthy to note that we should be having a DMO bond auction on Monday, where a total of 360 billion will be on offer, and investors would also look towards that. So we would then see some speculation going into that auction, but overall we should expect bullish sentiments for the rest of the week.
All right, thank you so much for bringing us up to speed. Appreciate your time on the show today. Dimeji Obasa, fixed income trader at Access Bank.